Moving averages, or MAs, are one of the oldest tools used in technical analysis and represent essential elements for many other technical indicators, such as Bollinger Bands and the MACD. A moving average is formed in the shape of a constant period average, usually fashioned by closing prices. Though calculation can also be based off highs and lows, for example, as long as data points are consistent throughout the calculation. MAs do a superb job in toning down price fluctuations, smoothing data, and making it easier to view underlying trends. You'll therefore find many trend-following methodologies adopt moving averages. The most common moving average is the simple moving average, or SMA, a calculation that applies equal weight to each observation. The SMA is calculated by dividing the sum of a set of prices by the total number of price points found in the series. So really, a moving average is just one value representing an average of previous data points. For example, a 10-day SMA is one number highlighting the average of previous price points for the past 10 days. Assuming 105, 115 and 90 are the three previous daily closing prices of a security, the total of the three values is 310. And to calculate the average price of these three values, we simply divide 310 by 3 to give 103 rounded. It's important to note that each day's calculation involves adding the most recent day's price close and dropping the earliest day's data. In some circumstances, though, recent price data may command more attention than previous price values. Fortunately, we have the option of applying more weight in favour of recent observations, consequently reducing the lag time seen in the SMA. A weighted moving average like the exponential moving average, or EMA, does just that. Whereas the SMA calculates an average of equal price data, the EMA, by applying weight to more current data, will follow prices more closely. Another important point to bear in mind is while the SMA drops off older data points, which can be problematic if earlier data displays considerable change, the EMA maintains older information. As for the EMA calculation, we must remember we want more weight on recent data. Guided by the formula on screen, the current weight represents the weight for the current day's data. Assuming a 10-day EMA, and assuming we want a weight on the recent price point twice as great as we would have in an SMA, we simply divide 2 by the number of days in the moving average and add 1. So in this case, it's 2 divided by 11, which gives 18.18%, or 0.1818. We then multiply this by the closing price on day 11, which in this example is 1.17515, which equates to approximately 0.2137. The MA weight, on the other hand, is what's left over after doubling the weight on the recent price point. So 100 minus 18.18 gives 81.82%, or 0.8182. We finally multiply this value by the previous day's EMA value, which is 1.17439, to get 0.9609, and then add 0.2137 to 0.9609 to give an approximate 10-day EMA value of 1.1746 on day 11. I understand this is a mouthful. Fortunately, though, most charting packages calculate moving averages for you. The primary function of all moving averages is to smooth price data, helping to establish current trend direction based on past price action. Therefore, moving averages are always going to be lagging indicators. Despite this, moving averages can also serve well as buy and sell signals via crossovers, as well as dynamic support and resistance levels when tested. Some traders also adopt mean reversion strategies based on moving averages. It should be noted that lag times vary depending on the moving average length. A 20-day moving average will track price movements more closely than, say, a 200-day moving average. Longer calculations obviously take in more data points. The 200-day price average, for example, could be higher, while the short-term price average is lower. This will send shorter-term moving averages lower, while the longer-term moving averages remain to the upside. The length of the moving average used by traders would also depend on trading style. Short-term traders, such as day traders, focus on lower period moving averages between 10 and 30. Swing traders, those interested in medium-term trends, look more towards the 50-period moving average, and longer-term position traders are more driven towards the 100 and 200-period moving averages.